Have you ever opened your brokerage app the day after buying a dividend stock, expecting to feel like a landlord and instead found $1.40? That's the moment that trips up almost everyone who tries this. You put real money in, you wait, and the first payment looks like couch cushion change. So you close the app and think, okay, this passive income thing is a scam for finance influencers. Here's the problem with that reaction. You're judging a tree by its first week as a seed. Today, I'm putting $10,000 of my own money into a real 10-stock dividend portfolio, live, right in front of you. Now, just to be clear, I'm not your financial advisor, and this is for educational purposes, but I'm going to show you exactly what this portfolio pays in month 1, why that tiny number is almost meaningless on its own, and then, we're going to run the math forward. I'll show you what this exact same $10,000 could become over the next 25 years based on historical market averages, assuming we automatically reinvest those dividends. The gap between month 1 and year 25 is the entire story most people miss. Hit the like button for the YouTube algorithm, and let's build it. Before we buy a single share, we need to fix how you're thinking about this. Most people bring the exact wrong mental model into dividend investing, and it wrecks the whole experience before they even get started. Now, quick reminder, I'm sharing my personal strategy for educational purposes, not giving official financial advice. Always do your own research. But here is the reality of why most beginners fail at this. If you're like most Americans who've dabbled in the stock market, you were taught to watch the price. Buy low, sell high, check your Fidelity or Robinhood app, and feel a little sick when the market is red. That's the traditional growth investing mindset, and it's fine for what it is, but it's the completely wrong lens for what we're doing today. Dividend investing asks a completely different question. Not, did the price go up today, but did this company just pay me cash for showing up? You're not trying to time the market. You're getting paid rent on money you've already parked. And while the underlying stock price will always fluctuate, your primary focus is building a growing stream of cash flow. In fact, according to historical data from S&P Global, dividends have accounted for roughly 1/3 of the total return of the S&P 500 since 1926. It is a massive wealth-building engine. But this is the exact moment a lot of new investors get stuck, and here's why. They buy 1 or 2 dividend stocks, they see their very first payout, and they do the math in their head. They say, $40 on $5,000 invested, that's a roughly 3% yield. That's nothing. This'll take forever. And they quit before the mechanism ever gets to do its job. That mechanism is what brokerages call a DRIP, a Dividend Reinvestment Plan. Every dividend that lands in your account, instead of sitting in cash, automatically buys you a few more shares. Sometimes a whole share, sometimes a fraction. Those new shares then throw off their own dividends next quarter, which buys more shares, which throws off more dividends. It's a small, boring, repetitive loop. And boring loops compounding over decades are exactly how modest starting amounts turn into real numbers. Nobody feels rich in month 3. That's not when this works. But there's a massive trap sitting right at the entrance of this whole strategy. And if you fall into it, none of the compounding matters, because the income you're relying on won't be there in 5 years. We call it the yield trap. If you're like most people who've searched best dividend stocks at 11 p.m., you've probably landed on a stock screener and sorted it by yield, high to low. Sitting right at the top are companies paying 9%, 10%, sometimes 12%. Your brain does the math instantly. $10,000 at 10% is $1,000 a year of passive income. That's incredible. And you almost click buy. This is exactly where I used to fail when I first started. I chased the shiny number instead of asking why that number was so high. In the US market, a massive yield is almost always a warning sign that a company is in trouble and a dividend cut is coming. If you want to know exactly how to spot a yield trap before it destroys your portfolio, and the 3 rules I use to screen for safe, growing dividends, hit the like button, make sure you're subscribed, and let's break down the exact criteria in the next step. Here's the actual math you need to understand. A stock's dividend yield is simply the annual payout divided by the current share price. So, a yield can get massive in exactly 2 healthy ways, and 1 deeply unhealthy way. It can be large because the company keeps raising the cash payout steadily over the years, which is exactly what we want. Or, it can be large because the stock price collapsed while the old payout stayed the same. The market is quietly telling you that the business is failing and a dividend cut is coming, but the yield only looks juicy right now because the denominator fell apart. That second scenario is what Wall Street calls the yield trap, and it swallows a huge number of first-time American investors. So, before any stock earns a spot in my portfolio, it has to survive a strict gauntlet, not just a vibe check. I look at 4 specific things on every single candidate, and you can find all of this for free on Yahoo Finance or your standard Fidelity or Schwab app. First, coverage by free cash flow. Is the actual cash coming in the door enough to cover what's going back out the door as dividends, with room to spare. Earnings can be manipulated by accounting, but free cash flow cannot. Cash doesn't lie. Second, the payout ratio. Is the company handing out 40% of its profit or 140% of it? As a general rule for standard US stocks, you want to see a payout ratio safely below 60%. Unless we are talking about a REIT, a real estate investment trust, which by US tax law has to pay out 90% of its income, you cannot pay out more than you make forever. Third, the streak. Has this company actually raised the payment year after year through major US recessions, or is this its first good year? In the US market, we look for what S&P Dow Jones calls dividend aristocrats, companies in the S&P 500 that have raised their dividend every single year for at least 25 consecutive years. Fourth, the balance sheet. Is this company loaded with toxic debt? Remember, under US bankruptcy law, bondholders get paid before equity shareholders. If they have massive debt to service, they will cut your dividend to survive. Run every stock through those 4 checks and something interesting happens. Most of the scary-looking, high-yield names get filtered straight out. What's left is a shorter list of companies that are almost boring by comparison. Good. Boring is what pays your bills reliably for 30 years. Exciting is what cuts its dividend the week you were counting on it. Now, let's actually put this to work. I want you to drop your favorite dividend stock in the comments below, and I'll tell you if it passes this 4-step gauntlet. And if you want to see me screen a stock live, click the video right here on the screen where we build a portfolio from scratch. If you see a stock paying a 5% dividend yield, your first instinct should probably be to run. Most of the time, a yield that high is a massive red flag. But there is one major exception in the US stock market, and to show you how to spot it, we need to stress test a real company. Let's look at Realty Income, ticker symbol O. They literally trademarked the nickname, the monthly dividend company, and for good reason. As of 2026, they are on a streak of over 670 consecutive monthly payments and more than 30 years of annual dividend increases. Their current yield sits right around 5%, which is noticeably above the S&P 500 average. Normally, that should make you suspicious. And if you look them up on a standard stock screener, you'll see a reported payout ratio that looks alarmingly high, often north of 100 or even 200%. On the surface, that metric alone screams that the dividend is about to be slashed. But here is the Wall Street accounting quirk that most beginner investors completely miss. Realty Income isn't a normal corporation, it's a REIT, or a real estate investment trust. According to their SEC filings, they own over 15,000 single-tenant commercial properties. We're talking about the Walgreens, 7-Elevens, and Home Depots that you drive past every single day. These are leased out under ironclad contracts with a weighted average lease term of nearly 10 years. Rent isn't optional. Because they are a REIT, the IRS legally requires them to distribute at least 90% of their taxable income to shareholders. But the metric that actually matters for a REIT isn't traditional net income. Standard accounting forces real estate companies to deduct massive amounts of non-cash depreciation, which makes their earnings look artificially terrible. Instead, professional investors look at FFO, or funds from operations. This is the actual cash the properties generate. And when you measure Realty Income's dividend against their FFO, that terrifying payout ratio drops to around 75%. It is comfortably covered. A stat that looks like a massive red flag on a free stock screener turns out to be nothing more than a real estate accounting rule. Now, I promise to show you 2 companies. Realty Income passed the test. But what happens when a company's high yield isn't a trick of accounting? Let's look at. If you want to learn how to spot yield traps before they destroy your portfolio, make sure you hit subscribe, and let me know in the comments, do you prefer monthly dividend stocks, or are you strictly focused on growth? Now for the opposite case, Chevron. This one yields a more modest, roughly 4%, depending on the day's market price, nowhere near alarm bell territory. And it has raised its dividend for nearly 40 straight years. That streak survived the 2008 financial crisis, multiple oil crashes, and a pandemic that famously sent U.S. crude prices plunging below zero in 2020. On paper, this looks like the safer, sleepier pick of the 2. Except energy dividends carry a completely different kind of risk that simply doesn't show up in a standard payout ratio, commodity price risk. According to historical data from the U.S. Energy Information Administration, oil and gas prices can swing 30, 40, even 50% in a single year for reasons that have absolutely nothing to do with how well the company is run. A stock can pass every single accounting checkbox today and still get squeezed hard if West Texas Intermediate crude falls out of bed for 18 months straight. The lesson here isn't avoid energy stocks. It's that every sector hides a different kind of risk. The checklist only protects you if you know which question to ask for which industry. With real estate, you ask about FFO. With energy, you ask about their break-even oil price. That's the whole game. One stock had a scary-looking ratio that turned out to be totally fine once you understood the IRS rules behind it. The other has a clean-looking ratio but carries a global risk that the ratio doesn't capture at all. Reading past the headline number, every single time, is what separates an actual income strategy from a screenshot of a spreadsheet. I ran all 10 stocks in this model portfolio through that exact same stress test. Here's the full lineup. Most Americans are terrified of running out of money in retirement. But what if your portfolio paid you every single month, no matter what the stock market was doing, who was in the White House, or what the Federal Reserve decided to do with interest rates? I built this dividend portfolio in 3 layers, the exact same way you'd build a house. Foundation first, then the structure, then the parts that make it grow. Here is the blueprint. Just remember, this is my personal playbook for education, not personalized financial advice. Layer 1, the foundation. These are the stocks that keep paying you whether the economy is humming or in a ditch. We start with Coca-Cola, a dividend king that's raised its payout for over 60 consecutive years, currently yielding around 2.8 to 3.1%. Next is McDonald's, sitting near a 2.3% yield with a dividend streak pushing past 45 years. Then we have Southern Company, a regulated utility yielding in the mid-3% range. This is the kind of business that gets paid no matter what, because people don't stop paying their electric bills in a recession. Finally, Realty Income, our 5% monthly payer. For stocks, for different reasons people can't stop needing what they sell. Pro tip, according to the IRS tax code, REITs like Realty Income are taxed as ordinary income, so consider holding them in a tax-advantaged account like a Roth IRA. Layer 2, the blue chip muscle. We've got Chevron, our energy payer yielding right around 4% with a streak of over 35 years. Home Depot, yielding roughly 2.3%, riding the fact that Americans are basically constitutionally incapable of leaving a house alone, something is always getting renovated. We add AbbVie, the pharmaceutical giant behind treatments like Skyrizi, yielding over 3% and having raised its payout every year since spinning off from Abbott in 2013. And Union Pacific, yielding around 2.2%. Federal transportation data shows practically every category of physical goods in this country touches a railroad at some point, whether you ever think about it or not. Layer 3, the growth kickers. Texas Instruments, a chipmaker yielding close to 2.9%, with a payout that's grown at a strong double-digit clip for 2 decades because semiconductors sit underneath practically every piece of modern electronics. And finally, Costco, the outlier. Its yield looks tiny on paper, well under 1%. But that's because the stock price has run so far ahead of the payout. What matters here isn't the current yield, it's the growth rate, plus their habit of occasionally dropping massive special dividends, like the $15 per share payout they dropped on investors in early 2024. Put it together and you've got 10 American powerhouses spread across 9 different industries. Beverages, restaurants, utilities, real estate, energy, home improvement, pharmaceuticals, rail, semiconductors, and wholesale retail. Every single one is a business that gets paid whether or not anyone is watching the stock ticker that day. If you had to pick just one of these to hold for the next 20 years, which one are you taking? Let me know down in the comments, and don't forget to subscribe for more no-nonsense wealth-building strategies. So let's actually build it. We're putting $1,000 into each of the 10 names, $10,000 total. Blend all 10 current yields together, and this portfolio starts out paying roughly 2.8 to 3% annually on the full $10,000. That works out to somewhere around $280 to $300 a year, call it roughly $23 a month. But that money is spread unevenly across the calendar, because in the US market, most companies pay quarterly, not monthly, and they don't all pay at the same time. Picture your first year like this. Some months you might see $8. Some months, when 3 or 4 companies pay in the same stretch, you might see $45 or $50. It's lumpy. It's not going to fund your grocery bill. And I'm not going to sit here and act like $23 a month changes anyone's life. If you clicked on this video hoping for a get-rich-quick number, that's not what this is, and any creator who promises you otherwise is lying to you. But here's the part that matters, that $23 a month figure isn't the destination. It's the seed. What it grows into, left completely alone and reinvested for 25 years, is the actual reason you're watching this. So let's run it forward. In your brokerage account, you turn on what's called DRIP, a Dividend Reinvestment Plan, which automatically uses your dividends to buy more shares. And crucially, let's assume you build this inside a tax-free wrapper like a Roth IRA, so the IRS doesn't drag down your returns every year. Using a blended historical return for this kind of dividend-paying portfolio, dividend growth, plus DRIP, plus modest price appreciation, we can average out to roughly 9% a year. This is intentionally a bit more conservative than the broader stock market's historical average, because this basket leans toward stability over speed. Here is the math. After year 1, this $10,000 sits at roughly $10,900. By year 5, it's projected to be around $15,400. By year 10, around $23,700. By year 15, the compounding starts to visibly accelerate, around $36,400. By year 20, you're looking at roughly $56,000. And by year 25, this same initial $10,000, never added to again, is projected to land somewhere around $86,000. That is the power of leaving good American companies alone to do their job. Let me know in the comments. Are you building your dividend portfolio in a standard taxable account, or are you shielding it in a Roth IRA? Drop your strategy below. That's not a typo, and it's not magic. It's a 2.8% starting yield, patiently reinvested, riding alongside dividend raises that, historically, across a basket of blue-chip U.S. stocks like this, have averaged somewhere in the mid to high single digits per year. It just compounds quietly in the background while you do absolutely nothing. And the income itself scales right along with it. That $23 a month starting point is projected to pay somewhere in the neighborhood of $195 to $210 a month by year 25. Not because you added another dollar, but because the number of shares you own, and the corporate payout per share, both grew while you weren't looking. Now, what if a $10,000 lump sum up front isn't realistic for you right now, but $60 a week is? That's basically one DoorDash order a week. Run that same 9% blended return with $60 added every single week instead. After 30 years, assuming you use a tax-free wrapper like a Roth IRA to block the IRS from taxing your dividends, you're looking at a portfolio projected to approach $500,000. At our same starting yield, that $500,000 portfolio would be throwing off roughly $1,100 to $1,200 a month in passive dividend income. Same mechanism. Same boring reinvestment loop. Just a different door into it. And if you don't believe the math, you can go verify every penny of this on the official secinvestor.gov compound interest calculator. But I want to be incredibly direct about something before we move on. Every number I just gave you is a projection built on historical American market averages, not a promise. Dividends can be cut, company growth rates can slow, and markets absolutely do not move in a straight line. Treat these numbers as a realistic range of outcomes to plan around, not a guarantee carved in stone. If this no-nonsense approach to wealth building makes sense to you, hit the like button and subscribe, because in the next video, we are breaking down exactly how to protect this portfolio from the next recession. Before we dive into the rules, a quick reminder, I am not a financial advisor, and this is for educational purposes only. Always do your own research. Let's bring this back down to what actually matters if you're building a dividend portfolio yourself. Most Americans get this completely wrong, but here are the 5 rules you cannot ignore. First, stop judging a dividend strategy by its first deposit. The first month is supposed to look unimpressive. That's not a bug, it's just where the math starts before the compounding curve bends upward. Second, treat a high yield as a red flag, not a promise. Right now, the S&P 500 average dividend yield is sitting right around 1.3%. So, before you buy a stock paying a massive 7% or 8% yield, ask what's actually covering that payment. You need to verify their cash flow, their payout ratio, and their track record through at least one bad recession, not just a bull market. Third, understand that every sector hides a different flavor of risk. Real estate investment trusts, or REITs, have major accounting quirks. You have to look at their funds from operations, or FFO, instead of standard net income. Energy stocks have massive commodity swings. Retail stocks live and die by consumer spending cycles. Your checklist only protects you if you're asking the sector-appropriate question. Fourth, and this is the one people skip. Turning on your DRIP, or Dividend Reinvestment Plan. It isn't just a nice-to-have setting buried in your Schwab or Fidelity app, it is the entire engine of your portfolio. Turn it on. Every dividend, every time, automatically buys more shares without you lifting a finger. But a quick warning, according to the IRS, unless you are holding these stocks in a tax-advantaged account like a Roth IRA, you still owe taxes on those reinvested dividends every year. And fifth, this only works if you actually leave it alone. That 25-year wealth projection I showed you assumes nobody panic sold during a rough quarter, nobody pulled the dividends out to buy a car, and nobody chased a flashier tech stock halfway through year 12. Boring, disciplined, and untouched is the whole strategy. If you want to build actual, boring, long-term wealth, hit the subscribe button. And let me know down in the comments. What is the most reliable dividend stock in your portfolio right now? Disclaimer, just a quick reminder before we wrap, I am not a financial advisor. This video is for educational purposes, so always do your own research before investing. If you want to actually build something like this yourself, 10 stocks, real coverage checks, a reinvestment plan you can see mapped out, you don't need anything fancy to start. Most major U.S. brokerages, like Fidelity, Schwab, or Vanguard, now offer free dividend reinvestment, officially called a DRIP, as a simple toggle on any dividend-paying stock you already own. Most also offer free portfolio yield and payout ratio tools right in their apps. You can use those to run the exact same 4 checks I walked through today on any 10 stocks you're considering, not just the ones in this video. Pick names and industries you actually understand. Run them through the coverage, the payout ratio, the dividend streak, and the balance sheet. Simply put, do not buy anything that fails more than one of those checks. And listen, you don't need $10,000 to start this. Thanks to fractional shares being standard across almost every major U.S. broker today, you don't even need $1,000. You can literally start with $5. What you actually need is a habit you will keep for 25 years. The math I showed you today isn't the reward for picking the perfect 10 stocks, it is the reward for not touching the portfolio while it compounds. If this broke down dividend investing in a way that finally made sense, drop a comment with which of these 10 industries you'd want to dig into next. I read every single one, and it directly shapes the videos I build for you next. Make sure to subscribe if you want the follow-up video, where I'll show you exactly what happens if you mix in a couple of high-growth, low-yield names instead of sticking purely to income plays. And finally, if you know someone who quit dividend investing because their very first payment looked like pocket change, send them this video. Sometimes, all it takes is seeing where month 1 actually leads. You've got the checklist now. Go build the thing.